Welcome, everyone. We appreciate there's lots of turbulence and volatility right now and some exciting headlines. We certainly want to talk about that, address that, and that is the whole purpose of today's presentation, going through what's happening with tariffs, what's going on with the market, giving you our insight and what might lie ahead. Of course, before we get too far into any presentation, we must always show the disclaimer, so I'll make sure it's on the screen here so everyone can see. And then we'll jump right in with what's going on, talking about the center of all the action here, Kevin. That's the U.S. market. And of course, tariffs and the big headlines are part of the reason for the uncertainty, because there's really no outcome as of yet. And businesses and investors like to have a little bit of an idea of what it is that could be around the corner before they make a big decision. That type of uncertainty can certainly weigh on a market. You've seen the volatility there since mid-February. That's the peak to where we are now in March. You've seen about a 10% decline. That would be a correction in the U.S. market. The bulk of the actions in the U.S. market, but Canada also impacted.
Yeah, and as we've noticed, I mean, it's been that sort of tariff scenario, right? It's come out and tariffs are being implemented specifically in Canada. China and Mexico have been the first places to go after it. So you would expect that if that's going to have that happening, there's going to be higher prices and everything along those lines. So it's going to have an effect on the Canadian market. As we've seen, the Canadian market was doing well until about that mid-February timeframe. But again, it's come off as well as the U.S. market, down about 6.5% year to date. Or not year to date, from the February high, should I say, till about 6.5% now. And again, this is an ongoing scenario that we have to monitor, seeing what's going forward. But like the U.S., it's one of those ones where until the tariff situation gets repositioned or it gets solved up somehow, we could see a little bit more volatility coming forward. And again, we're not quite as bad as the U.S. just based on the fact that we don't sort of have that same tech sector.
Yeah, I got ahead of myself there, but you have Canada, you have the U.S., and then a common question we get, and I fully understand the emotion behind it. When markets fall a little bit, people get afraid they're going to fall a lot. So a common question is this going to be a small or a large correction? We can use a little bit of data. I'll use history as a bit of a guide to see how we can answer that question. And it's tough, but if you're able to put all the emotionally charged headlines and the politics and just leave that aside and simply look at the data and at the market, I think you can come to the conclusion that this correction is kind of in line with what you could expect in terms of frequency of corrections in the market. And that's what this slide is trying to prevail and kind of give you that idea. Like a dip, 3% dip happens all the time, according to this history, about 7 times a year. A mild correction, well, maybe 3 times in a year, and then a 10% correction. You see that almost every year. We did not get any in 2024. 2024, we had high returns with low volatility. That was unusual. And coming into 2025, our expectation is you would see more volatility. That's what we said back in January. Now we're getting that volatility. So if you park the headlines and just kind of look at the market, the volatility is kind of in line with what we would expect. And it's also following the U.S. cycle.
Yeah, and as again, smaller or larger correction. I mean, if we basically, as Clint mentioned beforehand, take the emotion and the headlines right now of tariffs out of the lineup, we're basically following what normally happens in a post-U.S. election year. You'll find that you get the new government that's coming in, the new administration. Things do well till probably about the middle of February, as we see in this chart as well. And then you sort of get that sell-off. All the new initiatives have been put in. We got to see if it's going to be enacted. And that sort of goes mid-February straight through about the middle of May before you see any real change. And then you see an upward trend starting to go in the first year after a new administration comes in. So minus the headlines, this is not out of line at all with what normally happens in a post-election year in the U.S. So we would edge on the side that this is more of a small correction just based on it following normal patterns than if you had all that news going on and anything else coming up.
Yeah, and then also a little bit of data for small versus large. And this is a courtesy of Carson Group, specifically Ryan Dietrich. Since World War II, going back a number of years here, 48 corrections. That's according to their count. Correction meaning 10% or more of a drop in the market. And of those drops, how many turned into larger bear markets? Well, only 12. So 1/4 turned into a bear market. 3/4 were just, in fact, that small correction. So this leads us to think, well, 75% of the time when you get a small correction, it's exactly that, a small correction and not a larger bear market. In fact, that's rare. That happens only 1/4 of the time when you get market volatility. And then if you look at recent history, Kevin, what happened in the last couple of years, I think it increases the odds even more that this would be a smaller correction.
Yeah, I mean, rarer still, and we have to put it in the term of extremely rare. Are you going to find that you're having three bear markets in a really short time period, such as a 5-year time period? Which, if we have one now, that's what it's going to be. I mean, 2020 came along, there was a recession or a bear market. 2022 had a bear market. We'd have another one here. That would be the first time that's happened in 70 years. And again, that's sort of dictating to us that this is going to be an extremely rare occasion. Chances are it probably won't happen. And as we can tell, just based on there, you're usually looking at around that 10-year time frame for an average. So we're at least 5 years away from what should be going on for another bear market. So again, tends to lead to more of that small correction scenario as opposed to a larger one going forward.
Yeah, the onset of COVID there, March 2020, a big drawdown. 2022, another bear market. So a third one here in a 5-year stretch would be quite rare. But we don't want to just simply leave it at that. We got to say, what is it we're watching? What would be an indication where we think, all right, we think small, but you know what? This particular event is happening. Now we're going to have to change our mind. This would be one of them. This is the St. Louis Fed Financial Stress Index. So this isn't an investment of any sort. This is just an indication of financial stress in the economy. And you can see when it spikes, you get these shaded regions typically going along with the spike. And the shaded region is a U.S. economic recession. And they have these big spikes in financial stress typically associated with recessions. Even in 2022, you can see it came above the zero line here for an extended period of time. And then where we are today is down here, well below zero. So not a lot of financial stress in the U.S. economy right now, which leads us to think this could be more of a stock market reaction, less of an economic reaction. And usually you need an economic reaction to get a larger recession or a larger drawdown. And we're just not seeing that right now. And this is one tool we can use to gauge whether or not we are going to see that kind of economic stress. But that's not the only one we're looking at.
No, again, another one that we want to take a look at is traditionally if the North American or U.S. market in particular is going to go to that sort of recessionary time frame, or it's going to have a really bear market coming up, seeing as how it's the largest market out there, it usually has an influence on the global economy. But what we're seeing right now is not that at all. China is setting new highs in their market. As we can tell, international equities as well as emerging markets, according to the chart here again, they're showing positive returns year to date. So those are all positives there. The Canadian market is basically on a flat trajectory, and it's the U.S. market that's basically down compared to everybody else. And again, if you look at the U.S. market off a little over 3%, but the majority of that comes because the tech sector in the United States is having a horrid year right now. It's being really decimated. That's leading to this U.S. one. That's leading with the North American markets and basically being centered on the tariffs. But as we can say, if the rest of the world, basically outside of North America, is doing okay, chances are you're looking at more of a small correction. Again, can this change? Of course, everything's there. But based on what we've seen evidence-wise, this is probably not that bear market scenario we're looking at this point in time.
Yeah, and it also speaks to diversification, right?
Exactly.
The idea that if it is a small correction, diversification is working. This chart is year to date. So it's showing the gain in these various investments from January 1 until I created this on March 14th. And you can see outside of US and Canada, well, there's been a lot of investments that have actually done well, and having those in the portfolio and being well diversified has given you a little bit of cushion during the volatile component. And just to reiterate what you said, Kevin, here, China leading the path. China is usually seen as a riskier market.
Exactly.
That would not happen if you had a global bear market or a big recession. Usually the risky investments get hits. They don't make extra money like you're seeing right now. So another indication we're probably leaning towards a small correction. And then a bit of data here. This is a particular signal that I looked at, which is glossing over the nuance here, kind of high level. It looks at the relationship between high risk stocks and low risk stocks. When that relationship gets stretched according to certain quantitative measures, you usually see a bounce back in the market. That's what those green arrows are on the screen. So we've hit that point in the past. We've had 20 such market signals in the last 15 years. We got another one right here that happened just last week. So in the 20 prior occasions, Kevin, 3 months out, 6 months out, not great, kind of choppy and kind of volatile, but 9 months out of the prior 2019 were positive. That's pretty good. And then when you look 12 months out, all 20 were positive, and they had above average returns during that time period as well. I think that's a pretty good indication for this current bout. Next couple of months, maybe the volatility continues, but if your time frame is 9 months, 12 months or longer, you're probably in a good spot and probably going to have a rosier investment climate with that kind of horizon.
Yeah, and I mean that's the big thing. I mean, we got to make sure that you're not looking at panic and fear and everything else. Taking the headlines out of everything basically makes this more of an actual normal correction type scenario that we've seen in markets going forward. that's definitely something that you should keep in mind, that you can't let the emotions really run everything from there. But things that we think we'll see based on what's gone on, that volatility we do believe is going to stay for a little while yet, just because of the uncertainty on the tariff scenario. With that, what you're starting to see is you're getting declining interest rates in Canada. And basically what we're dealing with, we saw the first one happen last Wednesday. Right now, we'll probably continue to see more going forward. And that's because we believe tariffs are going to be around for a little bit, and that's going to stoke our economy. It's going to allow us to borrow at cheaper rates, which is going to allow the economy to continue to expand and deal with things along those lines. So declining interest rates in Canada are also helpful going forward with how the economy is going to run, but it's not just Canada.
Yeah, the U.S., we might see something a little different. The U.S. Central Bank, the Federal Reserve, has already said they want more clarity on tariffs before they start thinking about interest rate cuts. You have a scenario right now where the Canadian Bank of Canada, our central bank, is cutting rates. Those are declining while the U.S. is holding steady. So you're getting a wider gap in the interest rate environment in both countries. That type of gap usually hits the Canadian dollar. So we could see a bit of a sluggish dollar here, Kevin.
Yeah, and the sluggish dollar will probably continue the same way going forward. Again, as Clint mentioned, as long as the interest rate spread increases, the U.S. are higher than Canada, you tend to get the dollar to fall a little bit more. And again, we're probably not falling a collapse completely, but it will have a bearing on what goes forward as long as that rate discrepancy is there. And again, that's going to have an influence on what goes forward with us. But we do believe that the dollar will sort of stay in that sluggish state just based on the rates going forward. And again, it's because we're so tightly tied to the U.S. as opposed to other currencies around the world. That's going to have that sort of a bearing on us going forward.
Yeah, and we've already seen some of it in terms of what else should investors expect. Fiscal stimulus. Canada's already mentioned they want to be backing any of the sectors of businesses hit by the tariffs. They're not alone. You've seen more fiscal stimulus in Europe, Germany, an example where they did a big investment in the defensive sector there. And you're seeing that throughout other countries as well. So I think more fiscal stimulus is likely a theme for the remainder of 2025.
Yeah, and finally, what we'll probably see, at least in the Canadian markets here, is you're going to find the government searching for new markets to invest in. We've already been stating that. We're going to remove, if we can, interprovincial trade barriers to try and help stimulate our trade. And again, I mean, during the Bush years or the first Trump administration, we always said that we wanted to get into more markets and not be as reliant on the U.S. This time, based on the way things have gone, I believe that search will continue, and I believe we're going to have a little bit more going forward. So that new market government search should be there, something we should expect going forward, just to see what we can do with the products that we have here and avoid tariffing going forward.
Yeah, so unfortunately, we do think a little more volatility, probably not done just yet. We do think smaller correction over larger correction. So far, diversification has certainly been helping, as many other areas of the world and other strategies and asset classes have been doing well. But of course, it's always tough to endure volatility, extra hard to do it when there's lots of emotionally charged headlines. So if you have questions or want to discuss further, simply let us know.
Take care.